Okay, welcome to chapter 2.1. In this particular chapter, we will be studying the role of documents in accounting. Now, I've already said in the previous videos that everything that we are recording in accounting, it has to be proven with proof. We cannot just make up some numbers. Every time someone points out at any of the accounting documents and say, why do you have this number? You have to have source documents or a proof to prove that this is what you did and there's a reason behind these numbers. Okay, so we call it source documents because it gives you, it's the starting point of any of these numbers that you are recording into accounting documents. These are the source documents that we're going to study or you will come across in this course. The first thing is cash receipt. The name is already self-explanatory. Cash receipt is when you are having a cash transaction and you get the receipt for it. For example, when you as the business is selling something to a customer and receive cash back from that customer, we issue them a cash receipt. Same thing, when the business is going to the supplier, buys the inventory and pays them cash immediately, we also get a cash receipt back from the supplier. Electronic funds transfer is similar to cash receipt, but instead of a physical cash receipt, we are getting the EFT or electronic bank transfer. It's very similar to when you use the bank app to scan the QR code and pay for that. Sales invoice is for credit sales. At this point, you should already know credit sales is when a customer receives the inventory from the business but haven't paid, therefore, and then they will pay later. So when such situation happens, the customer receives the goods and the business would also hand them the sales invoice to say, this is how much you are owing us. Purchase invoice is when the business is going to the supplier, get the inventory, or maybe the supplier ships inventory to us, and we haven't paid, the business hasn't paid. And in a similar manner, the supplier will send us the purchase invoice to say how much this order or this inventory is worth and how much the business is owing the supplier. Credit note is when is for sales returns and purchase return. Sales return is when a customer is giving back some of the faulty items. All right, they bought it before, they haven't paid, but some of them are faulty and the customers are returning those faulty items to us. In the similar manner, a purchase return is when we buy something on credit from the supplier and we found out that some of these items are faulty and we are returning them back to the supplier. And along with that, the supplier will also send us the credit note. What exactly is the credit note? Think about it. If the customer is returning the faulty items to us and we pay them back the cash, it's very likely that the customers would use those cash in a different store, in a different shop. Instead of shopping with us, they're shopping with others, competitors, right? So in this case, instead of giving them back the cash, we issue them the credit note. Credit note is a document that says, let's just say the customer is returning one laptop that is worth $1,000. Okay, so instead of giving back $1,000 of cash to the customer, the business says issue a credit note worth $1,000 and says you have $1,000 to shop with us. So with that credit note, the customer cannot use that credit note in any other shops or stores. All right, they have to use that $1,000 within our shop. So that's what credit note means. Similarly, credit note for a purchase return, the supplier gives us the credit note saying you have $1,000 to buy inventory from us. You cannot use that credit note to buy it anywhere else. Memo or memorandum. is to take notes of what is going on internally in the business. So internally in the business, something might happen. For example, the owner takes out some inventory from us, or takes out some cash from the business, or maybe the business found out that some of the inventory has been lost, we figure out that there are some extra inventory that the supplier supplies us before. So such events happen internally in the business, and therefore the source document for that will be memo. And finally, bank statement. We don't discuss bank statement much in this course, so you can basically skip this part. Okay. So for cash receipt, in order to recognize cash receipt, we use the word REC, standing for receipt. And then EFT, or electronic fund transfer. So these two, REC and EFT, they are representing cash transactions, not credit. But the moment that you see INV, which stands for invoice, you know that they are credit transactions. So pay attention to those source documents. Credit note, CN, that's quite self-explanatory. Memo, standing for memorandum. Okay, next, 2.2. GST. GST is a tax on a sales or a purchase. Similar to VAT in Vietnam. VAT in Vietnam called value added tax. It's also 10% on top of the sales or purchase. Similarly, in Australia, we have GST, which stands for goods and service tax. So every time that you, as a business, you are purchasing or selling a good or service, you have to pay this tax. And that tax is also 10%. Okay? So imagine you are selling a, $3,000 laptop. Okay? You're selling a $3,000 laptop. So the sale itself, the sales, which is the selling price of the item, in this case, $3,000 laptop. So we are expecting to receive this much from the customer. Yes or no? No, right? Because when the customer buys something from us, they also have to pay the tax including in that as well. Not really including, but they also have to pay the tax on top of this. So what is the tax that we just learned? What's the name of the account for tax? We call it GST clearing. Okay? Remember that. The name for the tax account is called GST clearing, not just GST. A lot of students make this mistake when they are recording transactions. Okay? Sales, 3,000, and GST clearing, 300, because it's 10% of the 3,000. So the total cash that we are expecting from customers is 3,300. I hope this makes sense so far. The sales itself is 3,000. The tax on top of that is GST clearing, 300, and the total cash expected to receive from customer is 3,300. We call this number blue. This number is excluding GST. Excluding means doesn't include. Alright? So this 3,000 here doesn't include any GST or any tax yet. And this figure here, we call it including GST. Because within this number, there's already $300 of GST included in it. Right? Other than excluding, sometimes we call it GST exclusive Same thing in the same manner, GST inclusive. Right? Either including GST or GST inclusive. Either excluding GST or GST exclusive. So it's super important to understand which figure or any of this figure is including or excluding GST. Because sometimes in the question, we don't just say, oh, the sale itself is 3,000 and GST clearing is 300. We actually give you a little bit more complicated question than that so that we can test your understanding. So say, what I can say is, right? So instead of saying we are selling a laptop of $3,000 plus $300 of GST on top, we don't give it that easy to you. So we might phrase the question as the sales is $3,300, GST inclusive. Right? So when you see this number and it says GST inclusive, you have to figure out how much of this is GST clearing and how much of this is the sales itself. Alright? If it's excluding, that's easy. If it's excluding, you just simply time it with 10% to figure out the GST and then add the two together to get the including GST figure. However, a lot of students make mistakes in figuring out this one. The most common mistake is the moment that they see sales $3,300, they immediately assume that this one is without GST. They didn't even read the later part. So the later part in this question is GST inclusive, meaning this figure already has GST on it. Inside of it, right? So how do you figure it out without looking at these numbers? How do you figure it out how much is GST in this one, how much is GST, and how much is the sales? Very simple. You take this GST inclusive figure, divided, so GST inclusive figure divided by 11 equals GST clearing. Okay, so 3,300 divided by 11, immediately you can easily figure it out. Divided by 11 is 300, and therefore the rest of it, 3,300 minus 300, 3,000 is the sales. So, like I said before, the trickiest part in this particular chapter, it's not about memorizing or how much tax is that. We always know it's always 10%. The trickiest thing is whether you read the question carefully enough to know whatever figure you're reading, is it GST inclusive or GST exclusive? Now, I'm going to use the same example and show you the difference between the two if you make a mistake. Okay? Alright, so if you read this one without reading this part, you would assume that this one, the entire sales is 3,300, right? You would assume that because you didn't read this part. So if the sales itself is 3,300, then the sales would be 3,300. And because this one, you assume that it hasn't included the GST, you have to add the GST on top of that. So the GST on top of 3,300 would be 330. And therefore, the total expected cash coming from the customer is not like this. It's 3,630. Right? So, as you can see, if you're misreading the question, if you're misreading the information, the customer would have to pay either 3,300 or 3,630. They are totally different numbers. Okay? So be very careful when you're reading the question. Either it's a sales or it's a purchase. You have to be mindful of the GST inclusive or exclusive. Okay? Okay, 2.3. 2.3 is a very interesting topic because if you can get the foundation mentioned in this topic, you can basically finish the rest of the topic 2. Even in topic 3, actually. So let's do this. 2.2, we talk about double entry recording. What does that mean? So, you know, accounting is all about recording transactions, right? So, and in the transaction, it's very similar to your bank app. If you go into your bank app and you open up, you know, the transaction history, you will see a lot of information. One is how much money is going into our bank account. All right? Imagine if you have multiple bank accounts for different purposes, it will also tells you if it's going into bank account number 1 or bank account number 2. How much money is going into each of the bank account. It also tells you the source, which is where's this money coming from, right? So the source of the money, how much, and the destination of the cash. That's what accounting is all about, recording transactions and make sure that everything relevant is recorded onto accounting documents. All right? So, have a look at this diagram. In accounting, to make it easier to follow, whenever money is going into something, we call it debit. And the accounts that the money is going out of, we call it credit. Alright? So listen. Debit means money going in to whatever account that is on debit column. Whatever account that is on debit column, it means money is going into it. And whatever account that is on credit column, it means money is going out of that account. Okay? Same thing with this. So the rest of topic 2 and topic 3 will be using the same principle. Okay? So, and this is how the double entry accounting looks like. We call it journal. So each of these is called an entry. Each of these lines is called an entry. And the journal entries is to record all of the entries, all of the accounts that are affected by one transaction. Okay? This is called a journal entries for one transaction. All of these entries is to represent one transaction. Have a look at this. Okay? It has a date, the year, the day that that transaction happens, the accounts that are affected by that transaction, the debit and credit column. So now, if you already understand, credit means money is going out. If you see capital being on the credit column with this figure, what does it mean? Again, credit means money is going out. So this means 58,500 is going out of the capital account. And at this point, you already know that capital account means the owner of the business. Okay? So this much of money is going out of the owner's pocket money. That's it. That's the only meaning of this entry. This particular line here, that's what it means. It's on credit column, therefore this much is going out of the account. The question is, where is it going into? Right? So, have a look at this. It's going into these 3 accounts. How do you know that? It's on debit column. So out of this much money, 40,000 is going into the bank account. Whose bank account is this? The business. All right, remember that. The cash at bank account is here. So the owner, this much is going out of the owner's account, and it's going into 40,000 is going into bank, 2,500 is going into computer equipment, and $16,000 is going into motorbike. And if you sum up these three numbers, you will see that these three numbers would sum up equally to this number. Right? So what is going on here? Is there a reason that the owner is the owner's pocket money is going out, and it's all going into these three accounts? This computer equipment belongs to the business. This motorbike also belongs to the business. So what's happening here is the owner is contributing to the business 40,000 in terms of cash. That's why it goes into cash at bank. And the owner also bought a computer for business purposes. It also buys the motorbike also for business purposes. And that's why we have these entries. Okay? So again, credit means going out. This much is going out of the owner, and it's going into the cash at bank of the business. It's going into the computer for the business, and it's also going into the motorbike for the business. So technically, this entire journal entries recording one transaction, which is the owner is contributing to the business. And this particular owner is contributing three things: in cash, in computer, and a motorbike. As simple as that. Credit and debit. It might look a little bit strange to you because you've never seen these words, but it simply just means credit going out, debit, money going in. Okay? And as you can see, the last line in the journal entry, this one here, owner contributed assets. All of these are assets. Bank, current asset; computer, non-current asset; motorbike, non-current asset. So owner contributed assets to commence. Commence means to start up the business. And then memo. If you remember 2.1, we talk about memo is what is going on internally inside the business. And the owner contribution is internally. We don't involve customers. We don't involve suppliers. We don't take the loan from bank. Therefore, this one is called memo. And in order to know which memo is which, we have memo, the source document, and the number for that source document. So this is the typical format of a description of the journal entries, and we call this description a narration, which we will briefly mention in later. Okay, so this is called a narration. We have the description of the transaction, and also the source document and the number for the source document. So far, so good? Okay, the role of narration. I already mentioned you, briefly mentioned you in 2.2 about narration. So narration is simply just a description of the journal entries. This is a description, selling 3 laptops on credit. The format of that would be the description of the transaction itself, the source document for it, and the number for the source document. Yeah, that's pretty much it. And if there's any discount involved in the journal entries, you should also mention the percentage of the discount or the amount. Some questions might require narration or specifically ask you to write down the narration for some transactions, but most questions in this course says narration is not required. However, you still need to know the typical format of a narration so that you can write the narration for one transaction when you need it to. Alright, topic 3 is built entirely on topic 2's knowledge. So topic 2 knowledge, like I said, debit, means money is going into, and credit means money is going out of. Right? So, based on that, before I show you or I click on any of this chapter, let's apply that knowledge and see if you can figure out the entries before looking at the solutions in each of this chapter. Okay? So let's say cash and credit purchase of inventory and supplies. So let's start with cash purchase of inventory. Cash purchase of inventory, it means what? At this point, you should already know that cash purchase of inventory means that the business is buying inventory from the supplier and pays in cash immediately. Right? So that's what cash purchase of inventory means. So think about it. When you, as the business, purchases inventory from supplier and pays in cash, what's the diagram of the money? How does the cash flow is going? So this is the business, and this is the supplier, right? You pay cash, the supplier gives you inventory, right? So this is what happens. You pay cash and you receive inventory. Correct? Now, when you are recording accounting and transaction, we are recording from the business perspective, not from the supplier's perspective. Right? So from the business perspective, what we see is we are losing cash and we are receiving inventory. Yes? Now, or in other words, the cash is going out of the business and going into inventory. Right? In the form. So inventory technically is also a form of money. It's just more physical. Does that make sense? Right. So we're losing cash. We're losing cash. So if we're losing cash, would cash at bank be debit or credit? We're losing cash. Cash is going out of the cash at bank of the business. Then the cash would be debit or credit? Credit. Because credit means money going out. Right? So cash at bank will be on. So this one is debit and this one is credit. Let's just say we are buying $3,000 of inventory. And of course, when we buy something, we also have to pay tax for it, plus GST. All right? So if it's the inventory itself is 3,000, GST on that would be 300 because it's 10%. So the total cash coming out of the business would be 3,300. So this figure, 3,300, would it be recorded on the debit column or credit column? Credit, right? Because it's going out of the cash bank of the business. So 3,300. What is this money used to pay for? It's to pay for inventory, right? And it's also to pay for the GST. And remember, the name for the tax account in accounting is called GST clearing. This money is being used to pay for them, meaning money is flowing into those accounts. If money is flowing into those accounts, would it be debit or credit? Credit. Money is going into. So money is going into these two accounts. And therefore it must be on debit column. How much is going into inventory? 3,000. So 3,000 here. And how much is going into GST clearing? 300. This is the general journal entries or double entry recording for cash purchase of inventory. Same thing with supplies. Alright? And of course we're missing, so this is details column, which lists out all of the accounts affected by that transaction. And also we also have to have a date. Let's just say, I don't know what date is today, 11 March. That's it. So let's see if we are correct. Ta-da! Look at this. We're correct. We have cash at bank or bank, same thing. Cash at bank or bank are acceptable. On credit, cash at bank, on credit. Inventory and GST clearing on debit. GST inventory and GST clearing on debit. And these two must be added up and be equal to the credit. Okay? Think about it. They have to be equal. The total of the debit in one transaction must be equal to the total of the credit in one transaction. Because this is money going out, so the total amount of the money going out has to be equal to the total amount of the money coming in. Because we keep track of that cash flow. If, let's just say, I don't know, 5,300 is going out of cash at bank, but the business only receives $3,300 back. Then the question would be, where's the other 2,000? What did you do with the other 2,000? Right? So the total amount of money going out has to be equal to the total amount that money is going in. 3,300. All right, so that is cash purchase of inventory. We pay in cash immediately for the inventory and the GST clearing. What if we don't pay cash immediately? Right? Remember credit purchase? At this point, you should already know about credit purchase of inventory. It means that we're still receiving the business is still receiving the inventory from the supplier, but we haven't paid. The business hasn't paid. If the business hasn't paid and we are still receiving the inventory, if we haven't paid, the business hasn't paid, this money cannot go out of cash at bank because we are not losing any cash. So cash at bank is out of the question. Right? Instead, in this case, the accounts payable or the supplier will pay for this first, and then we will pay them later. Right? Because somebody has to pay for the inventory and somebody has to pay for the GST, the tax. But it's not us because we don't have any cash right now, for example. Or we don't want to pay now because we want to use money for something else. Right? So somebody has to pay for it. And in this case, it's the supplier that is going to pay for this. And the supplier that provides us with the inventory and we haven't paid, we call them accounts payable. Accounts payable. And for short, I just write them as AP. You should write it in full in your assessment though. You cannot write AP, otherwise you lose money. You lose mark. And for the accounts payable, we always write, other than just accounts payable, we have to write their name as well. Because we might be owing a lot of supplier, right? Maybe we bought some chairs from this supplier, we bought some chairs from some tables from these suppliers. So other than just call them accounts payable, just call everyone accounts payable, we call them accounts payable and then the name. So maybe let's just say the business is owing me, then accounts payable, Aiken. All right. So as you can see, the only difference between a cash purchase and a credit purchase is who is going to pay for it. If we, the business, pays for it, it's a cash transaction, the money goes out of our bank or cash at bank account. If we haven't paid, then the money has to come from the accounts payable, the supplier themselves. And then later on, we will pay them later. Okay? What if we pay them later on? I don't know, this is 2nd of July 2023. What if we pay them on 30th of July? We pay them this much. Because on this day we are owing them, right? The accounts payable, we are owing the accounts payable this much. Then on the end of July, we decided to pay them. What are the entries to record the payment to the accounts payable? Think about it again. Think about the cash flow. If we pay the accounts payable, who is receiving the money? The accounts payable, right? So the money goes into the accounts payable and it goes out of the business cash at bank. If you know this, which one of this account is debit and which one of this account would be credit? Credit means money is going out of. So this one would be on credit, and because this account is receiving money, it's debit. So how does it look like on general journal entries? How does it look like in this format? It will be the date, right? We always record debit entries first. Debit entries first, credit entries later. If in your assessment you change the order, you move the credit entries before the debit entries, there'll be 1 mark off for the wrong format. So always record the debit entries first, credit entries later. Okay? So in this case, we have to record this account first. AP, debit, how much? 1,100. And then credit entries, CAB or cash at bank, 1,100 on credit. We also write the debit figures on the left hand side and the credit and figure on the right hand side. That's it. The payment to settle our debt before to our accounts payable. Alright? Now, remember, okay, we already recognize the tax here. The total tax that we have to pay is only 100. If some students, one of the most common mistakes students often make when they're recording this transaction, payments to accounts payable, they think that they have to pay tax again on top of this figure. No. We already recognize the tax within this figure. See, this 100 is already included in here. So when we make this payment, total 1,100 going out and going into the accounts payable, we are already paying tax. Right? So do not, so some students would write it like this. AP 1,100 accounts payable and then tax. So GST clearing. 10% of this would be 110. And then therefore the total would be 2010. This is wrong. Okay? So we only have to pay the accounts payable figure. Right? So I'm going to write the correct answer again. AP 1,100 on debit and cash at bank 1,100 on credit. Next, cash sales and credit sales of inventory. Let's start with cash sales of inventory. Now, what does it mean by cash sales of inventory? We're selling inventory to customer and we receive the cash immediately. That's what it means by cash sales. And as opposed to that, a credit sale of inventory would be we are still selling the inventory to customer, but they haven't paid. That will be a credit sale of inventory. Okay? So let's start with cash sales first. In the cash sales, what happens is the customer is paying the money, and for the inventory that they received, right? So from the business perspective, I'm going to draw out the diagram so that it's the customer is paying for both the sales and the GST clearing, which is the tax, right? So they have to pay for the sales, the selling price for the product, and also the top on top of that. And all of this is going into, because it's a cash transaction, therefore all of this cash is going into cash at bank account, right? At the same time, we are sending back the inventory to the customer, right? So we're losing this inventory. We get all of these sales and GST clearing as cash into our cash bank account. So from our business perspective, what we are receiving, this is our cash bank account, right? What is happening is we are receiving cash into the cash bank, meaning cash bank would be debit, right? Because cash is flowing into the cash bank account, and debit means money going in. And this cash flowing into the cash bank coming from these two accounts, sales and tax. Therefore, this account has to be on credit. How do you represent that in the double entry accounting format? Again, debit entries first. So cash at bank would be debit, sales would be credit, and GST clearing would be credit, according to the diagram. So if the sales itself is, I already used this example, so I want to use it again so you don't get confused. If the sales itself is 3,300 is the tax on top of that, then the cash that we are receiving from the customer is 3,300. But this is only half of the sales. As you can see, in the sales, more than just receiving all of this cash into our cash bank, we also have the later part, which is losing the inventory. Okay? If the sales is 3,000, I'm expecting if we are losing the inventory, then the money is going out of the inventory account. Right? Inventory is losing the value or losing the money, then inventory must be on debit or credit. Losing credit. Right? I shouldn't write like this. We're losing inventory. Right? Being sent to the customer. So inventory would be on credit. Okay? Therefore, credit entries must be inventory, credit. If the sales is 3,000, let's just say we're having, so maybe the cost of the inventory is only, 1,800. So 1,800 is on credit entries, is on credit column. Because this much of inventory is going out of the business. When it goes out of the business, this inventory, when it goes out of the business, it's gone forever. From our perspective, we have already sold it to the customer and the customer has paid for it. From our business perspective, it's gone forever. When we lose the inventory forever, this is the accounting equation. When we lose the inventory goes down. Are we, the business, owing anyone in that transaction? No. So liabilities stay the same. If liabilities stay the same and an asset goes down, then owner's equity would decrease. Is this decrease because the owner is taking out the inventory? No. This decrease is because of the sales. So this particular inventory that we are losing, it decreases in asset, it leads to decrease in owner's equity, and it's not owner's distribution. It meets 3 dot points, all of the requirements for this one to become an expense. Therefore, we created a new account called cost of sales. Cost of sales. This one is an expense, and we are losing 1,800. All right. So these entries means all of this inventory related to this sales has been gone out of the business and gone forever. Okay, we're not getting back. So we call it cost of sales. Or in other words, this is the cost of this sales. Sales is selling price, cost is cost price. So this is selling price 3,000, and the cost of this 3,000 is 1,800. Where do you get this cost from? The inventory. So at this point, some students might find it confusing between these two accounts. Inventory. Let's just say we have, I don't know if you can see it from here, maybe here. We can have this much of inventory. Maybe we have $10,000 worth of inventory. Okay, in our warehouse, we have $10,000 worth of inventory. But then today, we make a sales. Obviously, we have to take the inventory from this $10,000, right? But we are not taking $3,000 of inventory because this is just our selling price. The actual amount of inventory that we are taking out is only 1,800. So this 1,800 is only a very small part, maybe up here, 1,800. Right? Maybe too small. 1,800, right, is being sold. So this 1,800, this red part here is called cost of sales. Cost of sales. This is cost of sales. This is inventory. So after this transaction, after we sell this much of inventory, the inventory we have left would be $10,000 minus 1,800 equals whatever that is. Okay, so that's the difference between inventory. Inventory is all of the inventory we have in the warehouse, whereas the cost of sales is the inventory that we sell to customer. The cost of the inventory that we sell to the customer, which is gone forever. That's the cost of sales. Okay, so it's very important that you know that. So basically, we're taking a little bit of inventory and put it into the gone forever inventory part. That's why we have credit and debit entries on this case. Similarly, this is cash transaction. When we sell inventory to customer, we receive the cash back. But what if it is a credit sales of inventory? Credit sales means we are selling the inventory to customer, but they haven't paid. If they haven't paid, we cannot receive any cash into our cash at bank account. In this case, we call it accounts receivable. So basically, the entire sales is being held by the credit customer, right? It's instead of the cash going back to us, the customer is holding on to that cash, and later on they will pay us. Okay, so later on when they pay us, what would happen? What would happen to the cash flow? When they pay us, who is receiving the money? When the customer, that credit customer pays us, who is receiving the money? Us, the business. Into what account? Cash at bank. And this money is coming from the credit customer. What's the name for the of the account for the credit customer? Accounts receivable, and of course with their name, maybe Luna. How would you represent this onto a double entry accounting? Which one of these would be debit and which one of these would be credit? This one would be, debit, because money is going into it. And this one would be credit, because money is going out of it. So easily you can write it as cash at bank, debit, and accounts receivable with the name credit. This is the journal entries for when they pay for it, when the customer pays us. And this is the journal entries for when the sales happen. Cash sales of inventory and credit sales of inventory. For credit sales, everything else stays the same, except for instead of cash, we have accounts receivable.